Hey traders, hope you had a great week. It's been a lot of fun. It's been a crazy thing to watch all these most shorted stocks go nuts. This video is going to do a deep dive into a option strategy that I saw on CNBC by John Najarian. Now, this is going to be some big brain stuff. This is not how to YOLO some calls or puts. This is going to involve multiple legs of options, but I want to learn what he was doing to advance my own understanding of complex option strategies. And so I was going to share my thought process as I go through analyzing this strategy because it's not a standard strategy. You'll see. So this is the actual, I took a screenshot of it when it was on. So what he did, this was on Wednesday. This is when it was trading and probably around 300 on Wednesday. So it was before Thursday's craziness. He bought the April 60 puts and sold the March 50 puts. Now, this right here, these first two legs, what this would be is a diagonal. And that means that he is buying one option at one strike in one expiration and then selling a different strike in a different expiration. So it's a pretty standard strategy by itself, still complex, but the next things he did was bought the April 30 puts and sold the April 40 puts. Actually, I'd reverse that and I'd say he sold the April 40 and then bought the April 30 below him. And that is just your standard put credit spread. So it's a combination of a diagonal spread and a credit spread all in the put chain. And what makes it kind of complicated is he's got the March in there. So it's definitely not an iron condor because there's a certain timing component involved in letting that March 50 hopefully expire before the Aprils. So he's selling that, not expecting it to get to 50 before March so that he can just collect that premium to offset the cost of the trade in general. And let me bring up my handy dandy calculator real quick, if I can spell it. And so as he has it listed here, he would have bought the 2061, offset that by the 13, bought these 635, and then offset that by 1050. And that's about right. That's about 446. I actually tried to put this trade in a little after he did. It was going to be supposedly about $5, but I could not get filled, and the spreads were going all over the place. The spreads over these are dollar wide, so it would have been very hard to fill, and I just kind of got tired of it because it did have a greater than 5 risk, and you'll see that in the risk graph. What this is the risk graph that I drew. It was in Thinkorswim when I was evaluating this. Now, this may look kind of wonky, but I'll try to explain it. So what the purple line represents is the date right here, 127, when I was evaluating. In other words, this is what the theoretical value of the option should be at that moment, or the P&L rather, excuse me. In other words, if it were to have suddenly dropped to 100 immediately after putting this on, you'd probably be expected to be about down $250 if you paid the 5 or the 500 for it. If the stock kept on rising, you see that your risk does not really change that much. That's good. So it is a somewhat fixed risk trade. The blue line is looking at expiration of that March leg, which was 3/20/21. And that's where you start to see the real benefit of this. Like no matter what happens, his risk will increase a little bit. In other words, he could go from risking the initial 500 down another 500. Basically, if it goes to 1,000, his total risk would probably be about $1,000. But if it went down from any point from that 300 that it was on that day, then he starts to make money no matter what. I mean, as long as it keeps going down and goes down slow enough so that it doesn't quite get there by March. In other words, if it got down to zero before March, then he would actually be in trouble. So it looks like here the max risk that he's going to take on this is probably going to be about $500. So that's pretty good. Max profit though is over 1,500. That's in the ideal scenario that right around those April options, or excuse me, right around the March, it gets up to or gets down to $50. So it's pretty much like a 3 to 1. I'm going to use the risk graph here in Thinkorswim. By the way, I don't get paid to show Thinkorswim. It's just a great platform. If you're looking for someplace new, has some of the best big brain option analytics out there for the retail investor. And so I've gone ahead and plugged these in. These were actually from Wednesday when I first did it. So I'm going to we'll look at this first. So basically, if this was the 27th, and if we look at a couple of these different price slices, in other words, if it was 318, that's about break even, because that would have been basically the spread. Whereas on 127, that same day, if it had suddenly dropped, again, if it did too quickly, he would be down money. But if we go forward in time, let's say a month, and we evaluate those prices, now you see, even if it stayed the same, even if GameStop stayed at 318, he would be up almost one value of risk. If it goes down to 200, same thing. He's up about $500. 150, again. So in a lot of cases, he's at a 1-to-1 risk reward ratio. That's pretty good. And then let's go after the March expiration. So that Monday right after it. Now, if it's 318, not making quite as much profit. The 200 doing pretty well. If the stock goes below 50 or at 50, then he's going to make a lot of money. If we go forward in time, basically at that point, theta decay on those Aprils begins to eat at him. So really his target, if I'm just kind of inferring this, is he's looking to get it somewhere there around March expiration. Let's go back and look at a couple other things. There we go. Okay, so let's go to today's date. Let's see what it would have done just between here and Friday. And we'll open up and see what the prices are there. Okay, so basically puts went up a little more in value, but not too much. And see if I get out the calculator. Let's see what it would cost theoretically. Now the spreads are huge, so these are all just estimated. So about $100, $200. Yeah, so about actually right now, not accounting for the spread, probably this spread would be up. He's actually in profit at this point because the original one was about 446, how he presented it. So he's up a good bit on it. All right, so now if we take these, let's lock them in, and let's go forward in time, and we can see that as time goes along, that March option is expiring, and you're collecting that premium because price is not moving. And slowly, this purple line, which is the theoretical value on the date that I'm going through, it begins to get closer and closer to that max profit blue line as time goes along. Until finally, when we expire, now we're in a different territory where the curve changes, and the longer the time goes along, it doesn't get to 50, the less money we make. So it's kind of cool how that works out. One more thing to look at, because obviously if you look down here at the volatility, 500%, that is high. That is a very high number. We can adjust this and see, let's go forward about a month. Let's see what a volatility decrease will do to that, because if the excitement, if the fear starts to die down, volatility is probably going to decrease. But if the stock goes down, volatility increase. But it'll be interesting to see let's just see here. So -10. So let's just start increasing this volatility and see. All right, so basically our theoretical prices are going down slightly. So 318 is 363. Let's go down, let's see, we lose like 100%. A lot. Yeah. So this option strategy would be sensitive to volatility decreasing. So as long as volatility stays high, which ideally it should if the price does come down in his favor, he should get mostly the full value that he's looking at. So at the end of the day, it's a maximum 3-to-1 reward risk that he's looking at if it plays out perfectly. As it goes along, it starts to lose a lot less money, but he's basically betting on this returning to 50 by March. And he's been doing this for a long time. I have a lot of respect for him that he puts these out there on CNBC. I don't have that much respect for a lot of the people that call stuff on CNBC, but he's been doing this for a while. And it looks to me like he has the experience to know, okay, in his head, I want the stock to be this price by this time, and is able to put together a complex option structure that can express his trade. So I really wanted to understand that, and I think I have a little bit better understanding now. I hope you guys, if you stayed around to the end of this, also got it as well. So we'll see you in the next video.